So much, Mayor.
These are more rhetorical questions. Okay, everybody, we're calling the joint quarterly meeting of the City of Jacksonville Beach Pension Boards to order. Madam Clerk, can I get a roll call?
Nick Curry.
Here.
Dan Jansen.
Here.
Christine Hoffman.
Here.
Brandon Beresma. Eddie Bagara.
Here.
David Cohill.
Here.
Marvin Dupree.
Here.
John Galarno. John Gastilla. Jason Sharp.
Here.
Gaylord Cameron.
Here.
Ed Dawson. John McDaniel.
Here.
Dennis Poplowski. Debbie White.
We have a quorum for all three boards. I want to take a moment to welcome and introduce Kimberly Bennett. She is our new HR director. So she's in her second week with the City of Jacksonville Beach. So please take an opportunity after the meeting and introduce yourself to Kimberly. I'm sure we'll be seeing a lot of her with our pension board meetings and other city-related events and meetings. Next item is courtesy of the Florida visitors. Do we have any visitors that would like to address the pension board? Next item, administer oath of office. You said you already did that?
Yes, ma'am.
Okay, so please welcome Dan Jansen. He is filling one of the city council seats on the General Employees Pension Board and has already taken his oath, so he doesn't have to go through that awkward exchange that we all had to go through in front of everyone. Next item under legal, we have Pedro Herrera to discuss legislative update and an update on legal matters. He is joining us here soon. Take it away.
Hi, good afternoon. Can you guys hear me okay?
Yes.
For better or worse? Okay. Well, first of all, it's good to see everybody virtually. Hopefully you guys are getting through this difficult time. I did just want to update you on a couple things. First and foremost, I'm glad that everybody is meeting together in the room because most recently the governor issued an executive order at the end of April, EO 21-101 and 102. And essentially what they provide is any kind of emergency measure that had been adopted by a municipality or a county, political subdivision, in the interest of COVID and COVID prevention, in line with the state of emergency declaration, are now invalidated. So the governor's executive order effectively terminates, invalidates any kind of local order which had been implemented again as a result of the pandemic, in terms of somehow restrictions or mandates. So mask mandates, social gathering restrictions, social distancing guidelines, capacity for certain events and things like that, which had been authorized under the local agencies' emergency powers, are now, based on the governor's orders, invalid or no longer enforceable. And so local agencies, local legislative bodies are still allowed or permitted or free to go through their regular legislative process and enact an amendment to their ordinance, right? A local law enforcing a mask mandate or enforcing social distancing requirements or anything like that. However, it must be authorized, obviously, through the regular legislative process. It can no longer be authorized through some sort of emergency power or emergency declaration. So what does that mean? I think locally, obviously, it means many things for the city, but I think most importantly for this pension board, if it had been operating under essentially an exemption to the requirement to meet in a public place under the Sunshine Law, that would no longer be permissible. So I'm glad that everybody is in the room, or at least we physically have a quorum of everybody in the room, so that the board is complying with the statute. Let me just take a minute there and take a pause. Does anybody have any questions on the governor's executive orders or how it would affect the plan or maybe tangentially the city, but that's certainly something for the city attorney to opine on. No? Okay. I'm seeing quiet. Good. Okay. So I'm getting better at reading the rooms on these Zoom conversations. The other matter I wanted to update you on was just legislatively. Session did conclude at this point, it's about 2 weeks ago, and really no harm, no foul. So nothing was passed that would impact our plan. There was a bill that did get a lot of press and potentially could certainly affect some of the members former members rather, and that's the bill that was seeking to close FRS, the Florida Retirement System, the defined benefit side. This was a bill introduced by Senator Brandeis from Estero, and effectively what it did was it would have closed the defined benefit arm of the Florida Retirement System for all new hires as of July 1st. While it went through committee, it was actually revised to exclude the category special risk. So police officers, firefighters, correctional officers, and some statewide emergency responders, they would have still been permitted to participate in the defined benefit arm. However, obviously the majority of the population composing the FRS system are non-special risk, right? So general employees, elected officials, teachers, professors, et cetera. They would have been prevented, and anybody hired after July 1st would have gone into the investment plan option, which would have marked a fairly significant paradigm shift, I think, in terms of the public sector and defined benefit plans in general. Florida retirement system specifically is generally considered kind of one of the shining stars in terms of defined benefits across the country. And so, obviously closing the defined benefit arm would have been a significant shift. And I know we've probably discussed it here, and I'm sure you discussed it in the past as well. But the public sector generally follows the private sector in a lot of respects, and so the thought has been that defined benefit plans, for the most part, have gone away, are no longer utilized in the private sector. They've really primarily gone to a defined contribution model. So the thought has always been that the public sector would be following suit, right? And so there's been a big push, I think nationally, locally, obviously, to go to defined contribution rather than defined benefit. So this would have been, this would have certainly been a marked change, kind of in that direction. But it did not pass. It failed in the House side. So, we'll see what happens next year. But for the time being, it's really status quo. No change to our plan. No change to the Florida retirement system either. I did want to mention also, although it's not technically a legislative bill, it is something that has been introduced as part of the budget, which the governor was supposed to sign last week, but they're going to be holding a special session to go ahead and resolve the budget or approve the budget. But one of the line items included in the budget was going to be, or is potentially going to be, a $1,000 payment to quote unquote essential first responders. And so this has been something that it hasn't gotten a lot of press, but I did want to, obviously, for our police officers and for our firefighter members, just let them know that this is something that it is in the budget. It is expected to be signed by the governor, although obviously, through this budgetary process, it becomes kind of a horse trading event. So, we'll see finally what ends up getting signed and approved, but it is something that's been included as part of the initial budget, and something that I think a lot of folks are anticipating being signed by the governor, being included as part of the final budget. There hasn't been a whole lot of direction in terms of how it's going to be administered. It's going to be paid by the state, by the Department of Economic Opportunity. And I think part of the language specifies that there's supposed to be rules that are going to be implemented by the end of this fiscal year, so by 9/30. However, obviously we'll keep you posted, but that is something that could potentially help a lot of the folks in our plans. And then finally, I just want to brief you educational opportunities coming up for the board. If interested, the FPPTA is going to be holding a virtual conference coming up next week. I believe it's the 18th and the 19th. For those of you who are looking to continue their certification, or potentially garner enough credits to sit for the exam. The virtual conference will be offering CEU credits, continuing education credits. And then also the expectation is that the FPPTA will be holding a live conference in the summer, at the end of summer. I think it's June 28th or 29th. It's going to be held in Champions Gate over in Orlando. And so if anybody is interested in attending that, that's going to be a live conference, and I believe they're going to have a virtual platform as well. So it's going to be a bit of a hybrid. But if anybody is interested, excuse me, I would encourage you to potentially start booking hotel rooms, because I think I was at another meeting, and my understanding is that I think they had already booked about 100 rooms, and they haven't even released the registration site yet. People are just kind of booking rooms in advance. So I think it's probably part of the COVID buildup where everybody's just trying to get out. So those are available if anybody's interested. I would certainly encourage you to take a part and look at those. And then really that's it. That's all I had for my prepared remarks. In terms of just compliance going forward, I did want to, and this is something I can talk about with staff offline, but I believe the summary plan descriptions for each of your plans are probably due at this point. They should be updated every 2 years or so by statute. Obviously that's not a hard and fast rule, but it's something that we should look at. So I'll take a look at when the last time we did it was, and then if need be, I'll work with Dustin and staff to maybe get that in front of you guys for one of your future meetings. And really, that's it. That's all I had from my end, from my prepared remarks, unless anybody has any questions for me.
Any questions for Mr. Herrera? Thank you so much for joining us today.
You're welcome. Thank you for having me.
All right, moving on, old business. We have the approval of the minutes. Can I get a motion for approval of the joint quarterly meeting held October 28th, 2020?
Move to approve.
Is there a second? All in favor, please signify by saying aye. Any opposed? Motion carries, minutes are approved. We have a bunch of applications for retirement for the general employee board consideration. Do I have to do a roll call on all of these, Jody?
Yes, ma'am.
Okay. First one is to approve the retirement of John Rousseau, crew supervisor, deferred retirement effective 2/1/21, separation date 11/15/2019, meets age, service requirements for deferred retirement. Can I get a motion for approval from the general employee board?
I'll make a motion.
Is there a second?
Second.
Second by Regard. Any discussion? Roll call?
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Retirement approved. The next one is approved Richard Langston, line crew leader, backdrop retirement effective 3/1/2018, separation date 2/19/2021, meets age, service requirements for backdrop service retirement. Can you get a motion?
Motion.
Motion by Curry, is there a second?
Second.
Second by Vergara. Any discussion? Roll call?
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Next up, to approve Kathy Martinet, permanent specialist, service requirement of retirement effective 2/1/2021, separation date 1/29/2021, meets age, service requirements for service retirement. Can I get a motion to approve?
Motion.
Can I get a second?
Second.
Motion by Curry, second by Vergara. Any discussion? Roll call?
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Annette Hayes, motion to approve Annette Hayes retirement customer account specialist 2, deferred retirement effective 3/1/2021, separation date 10/10/2016, meets age, service requirements for deferred retirement. Can I get a motion?
Motion.
Motion by Curry, second
Second.
by Vergara. Any discussion? Roll call?
Nick Curry,
Yes.
Dan Jansen.
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Next up, approve Charles Saunders, utility plant maintenance supervisor, backdrop retirement effective 5/1/2018, separation date 4/30/2021, meets age, service requirements for backdrop service retirement. Can I get a motion?
Motion.
Motion by Curry, second by
Second.
Vergara. Any discussion? Roll call?
Nick Curry.
Yes.
Dan Jansen.
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Motion carries. Final is approve the retirement of James Trimble, electrical engineer tech 2, backdrop retirement effective 1/1/2019, separation date 3/31/2021, meets age, service requirements for backdrop service retirement. Can I get a motion?
Motion.
Motion by Curry,
Second.
second by Vergara. Any discussion? Roll call vote, please.
Nick Curry.
Yes.
Dan Jansen.
Yes.
Christine Hoffman.
Yes.
Eddie Guerrero.
Yes.
Good job.
Motion carries. All right, police board, you're up. We have application to approve the retirement of David McMinn, police officer, normal retirement effective 6/1/2021, separation date 5/5/2021, meet service requirements for normal retirement. Can I get a motion?
Motion.
Motion by Cohill, is there a second? Second by Stark. Any discussion? Roll call.
David Cohill.
Yes.
Marvin Dupree.
Yes.
Jason Sharp.
Yes.
Motion carries. Next up, approve the retirement of Randy Blaylock, police corporal, normal retirement effective 6/1/2021, separation date 5/24/2021, meets age, service requirements for normal retirement. Is there a motion?
Motion.
Motion by Sharp, is there a second?
Second.
Second by Cohill. Any discussion? Madam Clerk, roll call.
David Cohill.
Yes.
Marvin Dupree.
Yes.
Jason Sharp.
Yes.
Motion carries. Okay, that's the end of our applications for retirement. Now we have our consultant reports and presentations, and we will turn it over to Ryan Tucker. Yeah.
All right. Hey, guys, can y'all hear me okay?
Ken.
Yep.
All right, let's see. I'm going to try to share my screen here. Well, I'm unable to do that. Do y'all have the PowerPoint presentation we sent out?
Jacob here. No, we don't, but you should have the ability to share.
All right, when I go share screen, it says host disabled participant screen sharing. So maybe they could enable that.
Should I make co-host? Try now.
Try it now. There we go. Can you see that now?
Ken.
All right, we're in business. All right, well, I'm Ryan Tucker. I'm with Purvis Gray and Company. I've got Sean Toner with me. He's one of the CPAs on the audit team, and we're here to present the results of our audit for the fiscal year ending September 30th, 2020 for the 3 plans. Overall, the audit went very well. As you'll see as I go over a couple of our required communications. These first 2 items are in the audit report itself, but basically you're receiving an unmodified opinion on these financial statements, which is the highest level of assurance that you can receive from a CPA firm. We did include an emphasis of matter paragraph in our report just related to the global pandemic. We don't know what the results of that are going to be on the pension plans, but we did that is a standard communication in our reports and all of our reports as of late. Other required communications that are in our required communications letter, which is a separate document, is in regards to various items here, any accounting practices or policies. If there were changes during the year, we would need to disclose those. There really were none. Significant accounting estimates are in the area of your investment portfolio. Those are at fair value. And then the actuarial assumptions that are used in estimating the total pension liability. We evaluate these estimates during the course of our audit for reasonableness. And we felt like these are all reasonable estimates in your financials. There were no difficulties encountered during the course of our audit, and there were no corrected or uncorrected misstatements or disagreements with management. So that was positive. As far as the financial statements themselves, there are 4 sections included in each report. The first is, of course, our independent auditor's report. That's on page 1 and 2, which I mentioned. It's a clean, unmodified opinion. And then on pages 3 through 9 of each report is management's discussion and analysis. And this is prepared by management, of course, and it gives some financial highlights and year-over-year comparisons. And there's a couple of pie charts and graphs that include 3 and 5 and 10-year information in there, that if you don't have time to go through this entire report to look through MD&A, it's always a good source of information for financial highlights. And then the basic financial statements include the balance sheet and income statement, of course, and the note disclosures. There's disclosures that are required by GASB on significant accounting policies and principles. And there's a number of investment disclosures in there regarding investment maturities and the ratings of your bond portfolio. These are all required disclosures for every pension plan. And then there's some information about the net pension liability, which your actuary prepares, and the sensitivity of the net pension liability to changes in the discount rate is always an interesting disclosure if you have time to look at that. That's in note 5. And then we have required supplementary information. There's 4 schedules there that are required by GASB. However, our opinion does not extend to cover those schedules. They're not required to. So we'll touch on a few of these. The first is the statement of net position, fiduciary net position. This is going to be on page 10. Of course, this is just a snapshot of the assets and liabilities of each plan. These should be noted that these investments here are all reported at fair value as of 9/30. So from one day to the next, these could vary significantly, but this is how they're measured. And as far as the general plan, you can see there was a 6.1 increase in net position compared to the previous year, and about a 23% increase since 2016. We threw in 4 additional years here to give you a 5-year comparison. One thing that we did note that it was noteworthy about these plans this year was that you had a 10.02% investment rate of return, which was very good, particularly when you compare these to we looked at other plans that we audit around the state, and that this was on the high end of that. So hats off to the investment guys during that time period. But for the general plan here, you can see that didn't increase 10% because there was some fairly significant payouts out of the plan during that time period. And we'll see that in just a second. As far as the police officers plan, you can see it improved 9.6% from the previous year. Ended the year at 26.8 million of net pension assets. And that was a 34% increase since 2016 in the net position of this plan. And then as far as the firefighters, you can see at 15.2, it ended the year, which was a 10% increase. So that basically means that it held steady with the investment rate of return impacting at the end of the day, employee contributions and employer contributions and the contribution from the state essentially offset the benefit payments and administrative expenses that were going out of the plan. And so the investment return, made the difference there. These next schedules are the statement of changes in fiduciary net position, or what we call the income statement. It's just the results of operations for each plan for the fiscal year. And here's a 5-year comparison of the general employees. And the thing that jumps out is benefits and refunds in 2020 is quite a bit higher than they were over the last 5 years. And that was because of additional retirees and refunds. And plus there were 5 additional backdrop payments and 1 rollover payout during that time period. Sounds like they're going to be more even in 2021. But there are 193 retirees receiving benefits if you throw in the disabled and the beneficiaries. The normal retirement benefits were about 4.7 million. So the 5.4 includes all these backdrop and rollovers. So you can see on this graph here, the investment return, the best year there was in 2017, as far as improvement in net position. The police plan, you can see their benefits there are kind of averaging out. They've been fairly stable except for 2019. And that was because there were 2 larger backdrop payments resulted in that spike in 2019. There are 39, now currently there are 39 retirees receiving benefits. No significant backdrop payouts or rollovers in 2020 for the police. And then on the fire, one thing we did add, you can see in 2020, as we differentiated what's coming from the employer now that the city of Jacksonville is having to kick in 161,000. So you'll get to see that going forward. There are 24 retirees receiving benefits, and normal benefits have totaled around 861,000. There was 1 backdrop payment in 2020, so that was a little higher than normal. And there was 1 in 2019 as well. And there were actually 2 back in 2016. We look back at that. See, but that was a little higher year. As far as required supplementary information, these are the schedules that are there. These schedules will build to 10 years. As we go, we're 7 years in. So since this requirement came out as required by GASB. But here's a schedule that we kind of like to look at. This top section here, the total pension liability is calculated by Brad during the actuarial calculations. And then the next part down is just the planned fiduciary net positions, what we're auditing essentially. And so they compare the 2, and the difference is the net pension liability kind of at 13.6 million is down from 16 million in the prior year. So you made some headway during this time period, and your what they call the funded ratio is just now over 80%. The last time that happened was back in 2015. So we thought that was positive for the general plan. On the police plan, you can see the funded ratio is up over 90% now. So it's doing very well. You may say, well, why does the police plan always better funded? There's been quite a bit of turnover, in the plan, and the plan has more active participants compared to retirees. That tends to drive that unfunded pension liability. And then on the fire plan, you'll see that unfunded pension liability there went up to 77% and just under 80%, and that's going to continue to go up. The liability will go down over the next 9 years as the city of Jacksonville Beach kicks in, their $700,000 annual payment. So that was all 3 plans kind of improved their funded ratio, I should say, during that time period. That was what I wanted to cover as far as highlights of the report. We did want to thank Ashley Gossett and Rosalind Jackson and Eddie Vergara for all their cooperation during the course of the audit and their assistance in helping the audit process go smoothly. It always helps us out a lot from them pulling all the schedules we need, to prepare this report. I'd be glad to answer any questions you guys have.
Anybody have some questions? I don't think we have any questions.
Great.
That concludes your report.
Yep, that concludes it.
All right, are we ready to approve the report as presented? Let's take it by board. We'll start with police. To get a motion to approve the September 30th, 2021 audited financial statements.
Move to approve.
Motion by Dupree, is there a second? Second by Sharp. Roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
Jason Sharp.
Yes.
Police board approves fire. Motion to approve. Motion by Candler, second by White. Any discussion? Roll call.
Don McDaniel.
Yes.
Debbie White.
Yes.
Caleb Cameron.
Yes.
And general employees, is there a motion to approve?
Motion to approve.
Motion by Curry, second.
Second.
Second by Regard. Any discussion? Roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Guevara.
Yes.
All right, all three boards approved the September 30th audited financial statements. So we'll move on to Brad Armstrong. What's up there?
Can you all hear me?
We can hear you, but we can't see you.
Turn your video on.
What? No, I wanted to pause on, can you see my name, how it's spelled? Apparently the GRS marketing department told me I had to strengthen my name brand, so. So that's my branding joke. I'll get back to business. I'm gonna request the same permission that you gave Ryan to share my screen.
I just did it.
Okay. Let me see. It's just a second. There it is. Can you all see the presentation?
Yes.
Okay, great. So my name is Brad Armstrong. I work with Brad without an N. I work for Gabriel Roeder Smith and Company, and these are the annual actuarial valuations for the 3 retirement systems. The first slide after the header. Briefly, the purpose of the actuarial valuations is to determine annual required contributions for the fiscal year beginning October 1st, 2021. And determining the funded ratios of the systems and assessing certain risks and trends beyond the first 2 sub-bullets. The financing diagram, this you've seen before a number of times. It's basically allowing you to pay through the accumulation of assets, your investment income is able to pay a portion of your contributions, your benefit payments, excuse me, and moderate the employer contributions that would otherwise be permanently increasing for open groups in the case of the general employees and the firefighters, and less so for the firefighters now that they're closed and the remaining members are being covered by the city of Jacksonville Police and Fire pension plan. But this slide, I don't know if there's any new trustees or any trustees who've ever wondered a little bit about what the actuary does. Basically, we look at a lot of possibilities, but each individual moment in time, the potential that a monthly benefit will be paid is in fact developed as a present value. And present value is simply an amount of money payable in the future that if we had it today would accumulate to that amount that we expect that we will need, considering investment return and the probability that the money will be paid. The probability that the money will be paid has, at least a half a dozen or more different activities that we're trying to capture. Once somebody is eligible to retire, when might they retire, and might they withdraw and refund their member contributions? Might they withdraw and defer their benefit to eligibility for retirement, and so on, or potentially become disabled, or die in service and leave a beneficiary. So I use 7.5% because the general employees retirement system and the police officers retirement system are presently using 7.5% interest. And I kept this really simple. So the probability the money will be paid is certain. So the second sub bullet is 100%. So we're just dealing with investment return. So if we need $1,000 payable 1 year from now, with certainty, that's a present value of $930. I don't need $1,000 on hand today because I'm going to earn or expect to earn 7.5% over the next year. So the 930 invested in your portfolio would grow to $1,000 when I need it, and we'd pay that out and meet the benefit payroll for that particular circumstance. Now that happens when somebody reaches eligibility 12 times a year. So, we do that iterated multiple times over periods of years until what actuaries refer to as Omega. And Omega, not sure if it's related to the movie Omega Man with Charlton Heston, but effectively Omega is the end of the mortality table. So you can stop calculating if there's no expectation that anybody is going to be alive anymore. At 110 years old, most of the mortality tables effectively reach Omega. So they think you will have no probability of having to pay anybody beyond that point in time. And what that leads to is a finite number of calculations. Even though there's thousands of calculations, we look at every individual member for each of these moments in time. It's still a finite amount of calculations. It's just summing them up and making sense of it that leads to the actuarial profession being a professional that helps you base decisions on funding and the financial success of the retirement systems. So, and this is a pie chart graphical representation of how this all plays out. So once we have these present values all summed up, how are we going to pay for them? Well, we have a very significant amount of assets accumulated already. This isn't any of your systems specifically, but there's this purple section which represents the unfunded liability that we have to amortize and pay that off. So there's a yearly amortization payment to exhaust the unfunded liability until each of the systems reaches 100% funded. And then the present value of future normal costs is funding the future service that we expect the members to earn that will result in additional benefit payments. So if we pay the yearly normal costs and the amortization payments, eventually this pie chart will all be blue, so the assets will fully fund. And in fact, the firefighters retirement system is projected to reach that point in time because they no longer have new members that will create new present value of future normal costs. So their pie chart will be expected to reach 100% funded a little bit quicker and completely match the assets to the liabilities. So now this is really, the next two slides are a brief summary of the basic asset of, active retired invested terminated member data. And the primary purpose here is just to remind the boards, you have a fiduciary responsibility to provide benefit security. And so you just heard from your auditors that you have a very good plan sponsor who's consistently making the appropriate contributions on a timely basis. So that's a key. And by our assessment, we will recommend required contributions prospectively each subsequent year, so that the plan sponsor keeps paying the contributions and provides for these benefits. So, and what you'll notice is you have over 250 people who are reliant on income from your 3 retirement systems right now. So that's a lot of households that have financial consequences if for some reason you weren't able to meet the benefit payroll that they are expecting. So the firefighters are now down to 25 members, and those members will be retiring probably in the next 10 or 15 years. We expect this fire number to go to 0, and then you won't have nearly as many assumptions to deal with for the firefighters retirement system, because basically you'll have mortality and the assumed rate of investment return. So that will simplify the firefighters, although there's always the risk that the commitment, if you don't have any active firefighters participating, then the firefighters retirement system kind of becomes the orphan stepchild, if you will. And we want to ensure that the assumptions are more conservative, and therefore you're going to hear this a little bit later. The assumptions are presently 0.5% lower for the assumed rate of investment return for the firefighters. So the expectation will cause us to fund up to that 100% funded ratio a little bit quicker, and also put a little bit less pressure on investment return prospectively for that system. The funding value of assets is really just a tool to manage contribution rate volatility in the face of the market value of assets being relatively volatile itself, and no period represents that better probably than the last 12 months from, I guess it's 14 months now, from March of 2020, where there was a severe decline in the markets. And imagine if you had a March 15th or March 31st fiscal year end, then the city's contribution rates and requirements would all have increased substantially, whereas with this 5-year smoothing, that takes a lot of the edge off of that. And this is a little bit of a technicality, but the reason you see 7.6% and 7%, and I was wrong, it's not 0.5%, it's actually 60 basis points. The difference between the general and police assumption and the firefighters assumption is 60 basis points. This is because this is a retrospective assumption. It's presently 7.5% and 6.9% for general police and fire respectively. So, but in terms of assessing the 2020 performance, we looked at the assumptions as of the beginning of the plan / fiscal year. So that's why those are a little bit different than what you're going to see later. And this is a numerical representation. And what I want you to focus on is that all 3 of the retirement systems with the funding value of assets sit in a very favorable position. These positive numbers mean that you have unrecognized investment gains that you're expected to recognize in the next 3 years. So that's a little bit of a rainy day fund, if you want to think of it that way. So we expect a slight bias towards reporting more favorable experience over the next few years. If we go to the next slide, the contributions expressed as percents of active member payroll are represented for general, police, and fire. The city's portion is what these actually aren't what the stumbling with my text here. The city actually isn't contributing on a percent of payroll basis. What you see here is a representation for the firefighters that is a dollar amount, and that's because payroll is becoming obsolete. It's less and less meaningful for the firefighters. It's going to go to zero, and you can't have an undefined contribution rate if you're dividing by a zero payroll. So the level dollar amounts are shown here for, I think, the first time, and for fire specifically because they've closed. And the city's portion here includes Jacksonville's amount, but if we go to this page, it will make a lot more sense. So now the dollar contributions are the basis upon which the city's making their contributions that they're responsible for. And in this little box for fire, you see the city of Jacksonville will be responsible for $121,298 of the $791,510 for fire. These will be effectively, these three numbers are the contribution requirements. If you adopt if each board adopts these reports today, basically these become an invoice to the employers. And as I said, the invoice to Jacksonville Beach is $680,000, and Jacksonville is $121,000. Now, we also do 5-year projections. The effectiveness of years ago, we used to do 5-day projections, and the board didn't find those very useful. That's a little bit of levity to see if anybody's paying attention. But anyway, these are 5-year projections. Everybody's mics must be muted. Hopefully they're piping air into the room, so everybody's still breathing. But what you see here in this final column, the dollar amounts, for starting with general, these are generally increasing. They're expected to increase with wage inflation. So they're deliberately established with the expectation that they'll increase about 2.5% per year. And that's what you see here. So things look pretty good when we project forward with respect to the general employees retirement system. Police officers are pretty flat, not as expected, because we would expect the police officers' contributions would project to go up about 2.5% per year as well, just like general employees, because they're using the same assumption. However, what's keeping these contributions on a projected basis from going up more than they do here is there's a $90,000 cap that's affecting far more of the police officers' new entrants as far as normal cost. So that $90,000 cap is not indexed for inflation, so it will impair more on an expected basis, more high-level police officer positions in the future than it does today. And whoops, and the doggone, the firefighters are not expected to increase because they're funding on a level dollar basis, and they have a declining active payroll. Remember, there's 25 actives projected to go to zero over the next 10 to 15 years. And so as people retire out of the active workforce, there's no longer a normal cost component, for the firefighters. And so that's why we see a decrease projected contribution amount for the firefighters retirement system. And then the observed experience, I'm not going to spend a lot of time numerically reading the first three sub-bullets because I'm going to talk about it again on the next three slides. But the aggregate experience gain of the system and the assumption changes are a part of the increase in the funded ratios. And we talked about the investment return assumption a little bit, but the investment return assumption for police officers and general employees was reduced on a schedule from 7.6% to 7.5%. That schedule is currently reached its end. We were reducing a little bit year over year the last few years, but unless the board adopts a different assumption than 7.5%, we wouldn't expect that to change automatically next year without board action. The firefighters was reduced to 7% at the initiation of the interlocal agreement. And in addition, that agreement provides that assumption needs to reflect the current assumption of the Jacksonville Police and Fire Pension Fund. So the Jacksonville Police and Fire Pension Fund reduced their assumed rate of return from 7% to 6.9%. So we have to mirror that with the firefighters' valuation based on the interlocal agreement. So although the board didn't formally adopt that particular change, it's mandated as a provision of complying with the interlocal agreement. So now the risk measures, I told you we were going to talk about the funded ratio, and the funded ratio finally 2014, remember we're smoothing investment returns over a 4-year period. So 2014 was a little bit of a down period. And as I discussed, we were highlights don't work quite the way I want, but the funded ratio was kind of stagnating because we were making our assumptions more conservative over the last few years. But the FRS mortality change allowed the funded ratio to see pretty significant improvement for the general employees from 79.3 to 82%. All the other indicators are pretty favorable with regard to expectations. We should always be mindful of the non-investment cash flow. Remember the second slide, I'll go back to that just briefly. You remember this slide where the investment income allows you to pay benefit payments at a higher level than your current contributions. That's called negative cash flow. And you see that represented here in column 12. This is right in line with expectations based on that earlier graph. The reason for that earlier graph is a lot of people fear negative cash flow. They believe it's an unintended consequence, but it's absolutely expected and purposeful, and that's why we're pre-funding the benefits for the retirees, such that we can use the investment income to pay a portion of current benefit obligations. So let's move to police. And police saw a little bit more improvement. The FRS mortality for public safety was a little bit more favorable for the special risk members than for the general employees. So that's why you see a little bit of a more significant increase for police officers in their non-investment cash flow. Brian mentioned that you have more actives than relative to your retirees in the police officers retirement system than the general employees retirement system. And that's represented somewhat by the non-investment cash flow being less negative. So prospectively, it will mirror what we see for the general employees, but for the time being, the turnover and the number of actives relative to members in pay status are keeping the negative cash flow less negative. Finally, the firefighters saw the largest increase in funded ratio from 72.4 to 81%. So they were benefiting from the FRS mortality assumption that's mandated, that was adopted in this year's results, as well as the current funding policy for amortizing the unfunded is a lot more conservative. It's a level dollar method versus level percent of payroll, which is more conservative, which means, faster progress on the funded ratio. And it also is a shorter period than the other two systems. So you saw pretty dramatic improvements for the firefighters. And if we look at the non-investment cash flow, it looks even better than the police for the same reasons that I just stated, that we're putting in more money today with the expectations that we won't have to put in any additional money in the future once there's no more active members. And the city of Jacksonville actually contributed a little more than we expected, and that's what we call a contribution gain. So that helped the negative cash flow not be negative at all. In fact, it's a positive cash flow of 0.1% for the firefighters. That's probably not likely to persist. It'll go negative again, but that's okay. We plan on it going negative. If it's trending past negative 5%, then the investment consultant would need to be brought in to determine, if the investment portfolio is well positioned to be liquidating more of your assets than we have historically. So that is, I think, everything with respect to the firefighters, except one last point. If Jacksonville contributed a little bit more as a city, if they contributed a little bit more, what about the members? When it was a single employer retirement system, the city of Jacksonville Beach would make up any deviations. If the members put in less than expected, then in a subsequent period, Jacksonville Beach would make that up. If the firefighters put in more than expected, then the city of Jacksonville Beach would get a little bit of a credit in a subsequent period. Now it's separated, and so the interlocal agreement specifies that we have to true up the member contributions with respect to what was projected on a dollar basis versus what was actually received. So I just want to in case that question entered anybody's mind or may after this meeting is over with, you may have thought, wait a second, how come those things aren't in balance? You specify a dollar amount and they contribute that dollar amount. How does anything get out of balance? So to the extent that it's ever out of balance, we're truing it up pursuant to the interlocal agreement, and that is reflected in the contribution requirements to Jacksonville. It's not a procedure that we ever had before, but we have it now. And it's a safeguard so that if there was any underfunding attributable to the fire members, let's say withdrawing or retiring much faster than expected, we wouldn't get contributions from those firefighters. And there has to be a way to get it from another source. So I don't have any, that's the end, other than disclaimers, which hopefully everything's accurate in the disclaimers, because do you realize every time you load an app, you have about 50 pages of reading in order to, with disclaimers associated with using that app. It's my understanding that the average person has, they wouldn't have enough time in a year to read all of the, Pedro, what's going on with all this legal stuff? But anyway, that's an odd way to conclude, but I'd open it up to questions if there are any. And I hope you will interrupt, during a presentation of mine, if I didn't make that clear.
He says nothing. He says no. Does anybody have any questions for Brad? Other than that? Okay, thank you. No questions. We'll go ahead and work our way around to approve the October 1st, 2020 70th annual actuarial valuations. Let's start with fire. Can we get a motion? Motion by White. Is there a second? Second by McDaniel. Any discussion? Roll call.
Taylor Cameron,
Yes.
John McDaniel,
Yes.
Debbie White,
Motion carries. Please, is there a motion?
Motion.
Motion by Cahill. Is there a second?
Second.
Second by Dupree. Any discussion? Roll call.
Jason Sharp,
Yes.
Marvin Dupree,
Yes.
David Cohill,
Yes.
Motion carries. General and police, is there a motion?
Motion to approve.
Motion by Curry. Is there a second?
Second.
Second by Vergara. Any discussion? Roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Vergara.
Yes.
Motion carries. Thanks, Brad. And whenever we see you in person again, we want to hear about the ponytail and the red pants. So just put that on your agenda.
Okay. Okay. Thank you. We really appreciate working with you all. Thank you.
Likewise.
I'm gonna turn my video off, but I'll be present if you need, shockingly, if you needed an actuarial opinion on something, but I doubt it. Thanks. Bye.
Have any burning actuarial questions, we will tag you back in. Okay, heading over to Brendan with
Good afternoon, everyone. I guess before I actually jump into the report, since you just approved the actuarial evaluations, you need to coincide with that. You need to set the expected rate of return for the next year, the next several years, and the long term thereafter. As you might recall, this is an annual requirement that the state put on us some 7 years ago. So I will recommend that the fire use 7% as your expected rate of return, and then the police and the general use 7.6% for your expected rate of return.
Wait. Can you hear me still?
Yes.
It's 7.5 and 6.9. I mean, the fire is 6.9.
I always forget this every single year.
I was gonna say the rate in the valuation report is different. I think it's that 6.9 that Brad just mentioned.
It's 6.9.
7.5 and 6.9. All right, I amend my suggestion to be 6.925 or 7.5 for police in general.
As far as timing on this, I think we can do that at the next meeting because I don't have that as an agenda item on this agenda.
Okay, very good. So the first item that I have in is actually the 1231 report. You had a kind of a workshop technically last quarter when we went through the report. Would you like me to kind of spend time on it, or do you really just want to, for the sake of the meeting, go ahead and approve it? We can kind of discuss.
Yeah, so we went over the last report last time in the workshop, but we didn't have an official meeting, so we could approve that. We went over and I think it felt best if we just go ahead and approve that one and then skip. Especially since the next report includes data from the previous quarter.
So we'll look for motions from the boards to approve December 31st, 2021, December 31st, 2020 quarterly investment performance report. We'll start with please. Motion by Sharp for a second. Second by Koval, any discussion? Roll call.
Marvin Dupree,
Yes.
Jason Sharp,
Yes.
David Covell.
Yes.
Fire. Your motion? Motion by Kindler, second by White. Any discussion? Roll call.
Gabriel Cameron. John McDonald, John McDaniel.
Yes.
Debbie White.
And general employees, your motion?
Motion to approve.
Motion by Curry, second. Second by Jansen. Get in there. Any discussion? Roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Guevara.
Yes.
Okay, the December 31st, 2020 quarterly investment reports was approved by all three boards. Moving on to the March 31st, 2021. Yes.
I'm sorry, this is Pedro, and I may have missed it, but did you guys approve the rate that was recommended by our consultant and by our actuary?
That's what-
So I recommended that we wait until the next meeting to do that because I didn't have that as an agenda item on this agenda. Is there an issue with that? There's thought since the next meeting will still be in this fiscal year that wouldn't be an issue.
No, I think that's okay. I'm sorry. I didn't hear that part, Dustin. But yeah, no, that's fine. Just,
Okay.
we could just list it on the agenda for next time.
Not forget to put it on.
So jumping into the March 31 report, I'll start kind of on page number 1 of that, if you have that in your book. The equity markets continue to, recover from the lows from last year. Really, it's been a wonderful run in the market. Kind of the big news items were the third round of fiscal stimulus that was approved during the quarter. And then really the continued news of the vaccine rollout. So more and more people are getting vaccinated. There's just a general sense of optimism that the economy is going to get back to whatever normal is faster, than perhaps some people were thinking. And the other kind of the general backdrop is really all of the economic indicators, whether it be unemployment, notwithstanding Friday's labor number, but unemployment, economic activity, manufacturing, all of the broad-based economic indicators are moving in a positive direction. So when you kind of just take that on balance, it's kind of the justification or the reason that markets continue to move higher, even though they've come a long way, which you'll see in a few minutes. If you look at the upper right-hand corner of page number 1, you get a sense as to what the markets did in the quarter. International stocks, and those red or pink bars, were up somewhere between 2.5% and 3.5%. Our large cap domestic equity, as measured by the S&P 500, is up 6.2%. That's really where we have the majority of the plan assets, at least our equity exposure. And then the Russell 2000, the small cap stocks, were up 12.7%, more than double what the large cap stocks were. The one thing to note here in the bottom part of that top right-hand graph are the green bars, which represent fixed income. Because we're looking at negative numbers that we haven't seen for quite some time. So within the quarter, and I'll kind of show you a little bit more on this in just a second, interest rates started to move up, And if you might recall, bond prices move opposite of interest rates. So as interest rates went up, bond prices went down, so we saw some negative numbers there. If you look in the bottom right-hand corner, you can see the last 12 months. Again, remarkable. This really starts back in, obviously, April 1, which is just coming out of the bottom of the market that was impacted by COVID. So it is obviously a wonderful 12-month period to look at. Somewhere between 44 and about 58% for our international benchmarks. And then our domestic S&P 500 was at 56%, with small cap up to 94.8%. So really staggering numbers. And then down at the bottom, the fixed income was essentially flat, depending on the benchmark, slightly positive or negative. The broad-based one was just positive by 70 basis points. If you flip to page number 2, just a sense as to what's been happening within the equity market. As you may recall, for the last 6 years, you've been hearing about growth outperforming value. Well, really, it started with the election. And I don't necessarily think it was the election itself, but that was right at the time that the vaccines were getting approved. And there was a sense in the market that, okay, retail outfits or companies other than e-commerce related businesses were going to improve and or survive. Because a lot of the time during the COVID market in particular, there was this thought, we're gonna buy everything from Amazon and do nothing but Zoom meetings. And so those tech kind of oriented industries and companies did particularly well, especially in that main part of 2020. But as the vaccines really started to make their way into the market and all this further optimism that we've reopened, we started to see this shift toward value. If you look at the upper right-hand corner of page number 2, it really continued through the quarter, and it's quite dramatic. So the value benchmark, and I'll use the 1000 index, was up 11.3%, where our large cap growth, the prior leader, was up 0.9%. So quite a dramatic shift in kind of a realignment of leadership in the economy or leadership in the stock market. If you look down the bottom part of the page, growth still did outperform value over the 12-month period. But when we looked at this 3 months ago, the difference was remarkable. It was like a 35% difference between growth and value. And here they are fairly close to one another. The other thing I'll just sort of mention there is we've been through a period of 6 or 7 years where growth dominated value. Over time, you can't have one segment of the market lead forever. It creates an unhealthy imbalance. So we've kind of been saying, I was probably telling you 2 or 3 years ago that value needs to have a resurgence. Obviously, it took a while, but here we are, and this is a healthy thing for the market. We can't have just a narrow component being the leader indefinitely. So very pleased to see value kind of making this comeback, and specifically in a positive environment. Oftentimes, value will lead when the market is negative. The broad cap index will be down 10, but value is only down 5. You outperform. Well, this is fantastic that you get outperformance on the other side. If you flip over to page 3, bottom right-hand corner, I mentioned interest rates. And if you look, the green line represents the most recent quarter end for the Treasury yield curve. And what you see is on the left-hand side of that graph, we're pretty stable with short-term rates. They fell actually just a little bit. But beyond the 3-year mark and beyond, you see a noticeable increase in interest rates. Now, in particular, with the third round of stimulus being approved, with, again, more optimism about the economy reopening and people kind of getting back to work and spending money, all of a sudden, a lot of folks started to say, well, we've got a ton of money in the system. We've got a lot of stimulus. The Fed has been very aggressive. What about inflation? And that just sort of speaking about it out loud caused the bond market to start to react and worry a little bit. That's why we're going to see negative numbers in the fixed income portfolio, because the 10-year Treasury doubled in 3 months. It went from essentially 80 basis points to 160. So we're going to look at some negative numbers, but the one thing I just want to provide some context is 160, on the 10-year is still a very low number by historical standards. So we had a huge jump up, but relative to kind of normal rates, that is still a small or low number. And so that by itself does not create a huge problem for the economy. We could probably get to closer to even 3% or more before that increase in interest rates really starts to take a bite out of the economy. Any questions on anything that I've covered so far? No? Okay, so page number 4, this again is a wonderful looking chart. We try to touch on this every time. It compares your plan assets, again, all three combined, in the blue line. So you'll notice you're up to $113.4 million. And it compares against that theoretical red line, which is the assumed rate of return. That again has changed over time. It used to be higher in the early years, but it's been ratcheted down a little bit over the last few years. But you'll notice your cumulative performance results in approximately $20 million of extra in the fund because you outperformed that assumed rate of return. The blue lines along the bottom represent the net cash flow of all the plans combined. And so again, you'll notice that your cash flow negative. You obviously heard that from Brad and everything already, but you've been able to grow your assets, continue to grow your assets, even though you're paying out more benefit payments than you're collecting in deposits. The next couple of pages get into the asset allocation of the plan. I'll touch on page number 6 very, very briefly, just to highlight that we are 6.4% and 1.6% overweight in our domestic and international equity exposures. And I have some updated numbers that I'm going to kind of revisit that with because we do need to address that particular item. But there's sort of a little, I'll call it a problem, but it's a good problem. And we'll touch on that in a few minutes. You go to page number 7, the actual returns of the plan. So we had a decent quarter relative to the benchmark. We were up 2.27%, and you beat the policy, which was up 2.23%, but we did place in the 80th percentile among public funds. For the fiscal year to date, and again, this is the 6-month number, the halfway point in our fiscal year, 12.86% versus 11.63%. So you're beating your market benchmark, but you are ranking in the 64th percentile against the public fund universe. For the 1-year period, 35.97 versus 33.8. So again, if we were all sitting here on April 1st last year, just absorbing nothing but negative COVID news, and we had said, okay, yes, things are terrible, but a year from now, I think we're going to be looking at a report that says we made 35 or 36%. Would you take it? I'm guessing most of you would have happily said yes. So here we are looking at a wonderful number, and again, very, very pleased to see that. If you look at over the longer periods, 3, 5, and 7 years, you'll notice you're ranking somewhere between the 15th and 21st percentile. So again, the upper quarter of the public fund universe, and in absolute terms, very strong. Over 11% for 5 years and 8.7% over that trailing 7-year period. As we move down the page, I'll just touch on the individual managers quickly. Vanguard Total Stock is an index fund. It did exactly what it's supposed to. Wells, your large cap growth manager, 1.5 versus 94. And for the year, 69.5 versus 62.7. So very good both quarter and year. JP Morgan is your large cap value manager. They were up 9.5, but they trailed the benchmark, which was up 11.2. And for the year, 49.8 versus 56. Again, this is a relatively new manager. They replaced MD SAS a few years ago. One of the things that the boards were interested in were their kind of defensive capabilities. If you recall that, the markets had obviously been running for a number of years, and we were interested in a defensive strategy. So in a market where it's up 56%, it's not all that surprising for them to not quite keep up. That is a very kind of expected result given the way the market ran through that year. The one that's a little bit different is Eaton Vance. They have kind of been a bellwether for you, outperforming in really all different markets. But they struggled in the quarter, 8.4 versus 10.9, and for the year, 66 versus 89. Again, it's tough to sit there and argue with a 66% rate of return, but that was well behind the benchmark of 89%. Now, longer term, they have still been a very good manager, outperforming, but certainly with the different gyrations in the market over the last 12 months, missed the boat. We don't have any immediate concerns. Again, obviously we always continue to watch these portfolios, but given given the way things have been turning between growth, between value large to small, they're making adjustments, and we don't see any long-term issues with that strategy. And then if you flip to page number 8, just touching on international, a little bit of kind of what I referenced earlier with, no, I'm sorry, I take that back. Euro-Pacific and WCM had very similar performance. So both of them were down for the quarter, down 43 basis points and 4 basis points respectively, versus the benchmark, which was up 3.6%. But what you'll notice is both of them outperformed for the year, 60% versus 50 and 59.6. That is something that we've seen in quite a few places in this particular reporting cycle, where a manager that did very well for the first 9 or the last 9 months of 2020 kind of got hurt or underperformed. So again, nothing a problem with the portfolios, but there was such a flip in the marketplace. What was working in the latter part of 2020 did not work in the first quarter of 2021. You can really see that there. The next on the page is Sawgrass. We talked about the negative returns. So Sawgrass is down 3.6% versus the benchmark of 3.58. So they underperformed by just a couple of basis points. Although for the year, they did outperform quite a bit, 96 basis points to the positive versus the benchmark of negative 1.67. So again, certainly starting to see the impacts of those rising interest rates on that portion of the portfolio. We also have the PIMCO Diversified Income Fund. That was down 2.5, but outperforming the benchmark, which was down 4.3. And then for the 6 months that you've had them on board, they're up 1.8 versus their benchmark of negative 97. So again, off to a very good start. And again, as a reminder, they replaced the Templeton Fund that you had previously. And then the last item in the mix is the real estate portfolio with JP Morgan, up 1.8% for the quarter, slightly behind the benchmark of 2.25. And for the year, 1.7 versus 2.91. Again, as these portfolios have somewhat of a lag effect, so a lot of the COVID implications, is in particular in office space and retail, those were being absorbed through the course of the year, and that's why you're seeing some of these lower numbers over the last 12 months, even though we're fully 12 months out of the immediate drawdown of the COVID impact. Any questions on any of the managers or returns that I have covered so far? Page 9 is just really a quick review of all of your managers and the fees that are being charged and or paid to each one of those strategies. And I'll just sort of highlight the number at the bottom. So your weighted average fee is less than 0.5%. So for a fund that has mostly active management, that is an incredibly competitive and low fee. So just wanted to highlight that for you. The other item is on page number 10 of this particular book. And it is just a quick handout. It is not plan specific, but what it does is it kind of takes a little bit of a deeper dive into the drawdown from February to March 23rd of 2020, and then the subsequent recovery, and just puts some numbers to what happened the following 12 months. So obviously the S&P 500, in those 23 days dropped almost 34%. The small cap benchmark dropped 40.6%. So certainly a terrible experience in a very short period of time. But in the 12 months that followed, you had just amazing, percentage recoveries. The S&P 500 was up 77.8%. The small cap was up 120.7% from the bottom. And really, this is just kind of further evidence or an example of why we, one, diversify the fund, and two, why we have a long-term outlook and policy. Because there were plenty of folks that were in the middle of COVID were saying, oh my gosh, this is going to drag on for years, go to cash, get out, things are going to be terrible. And this just kind of proves the point. You never know when those market returns are going to come. We stay invested, we rebalance through those periods, and you ultimately get to capture these wonderful returns that happen to come over the last 12 months. That's everything that I had for you related to the quarterly report. If there are any other questions, I might feel feel appropriate, you want to approve that now, or do you wait until the end and we can do it?
Let's go ahead and approve it now. Any questions for Brendan on the March 31st quarterly report? Let's go ahead and get a motion for approval from the police board.
Move to approve.
Moved by Mr. Dupree, second by Sharp. Any discussion? Roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
Jason Sharp,
Prior board motion. Motion by White, is there a second?
Second.
Second by McDaniel. Any discussion? Roll call.
Gaylord Cameron,
Yes.
John McDaniel,
Yes.
Debbie White.
Yes. And from the general employees board, is there a motion to approve?
Motion to approve.
Motion by Curry, is there a second? Second by Jansen. Any discussion? Roll call vote.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Garg.
Yes.
Motion carries, pass all three boards. Next.
So, agenda item 6C, it starts with a memo related to rebalancing. And the first few pages in the section of the book have your investment policy. And so I just want to reference a couple of things that the target ranges that are allowed in the policy are capped at 55% for domestic equity, 15% for international equity, and a total of 65% for all equity. And that number actually comes from the ordinance. That is a maximum that we have of 65% allowed in equity securities. So with that as the backdrop, if you look at that single loose page that I handed out before the meeting started this morning, this is a look at your plan assets as of this morning. So for one, the good news, we just looked at a report that $113.4 million. If you look at the bottom, you're up to $116.9 million. So I'll just speak to that for a second. Our fiscal year-to-date number in the March 31 report was 12.86. If you work in that extra $3.5 million into percentages, that takes our fiscal year-to-date number up to approximately 16.3%. So continued good news, continued strong plan performance. So just wanted to highlight that for you. Kind of the bad news is, if you look at the percentages, and I'll kind of look at that far left-hand column, or the two columns, the current allocation, what you'll notice is our total equity exposure is up to 68.8%. Certainly well above the 65% maximum that is allowed in the ordinance and obviously the policy. So the next section, as you move to the right on this page, shows target allocation. So if we just wanted to take everything exactly back to the target weight, it then lists the dollars in that add and reduce column. So every single equity portfolio you have is overweight. And so it would require obviously harvesting some of those gains and then taking some of that money off the table. And virtually all of it goes to fixed income. There would be a little bit potentially to real estate. You can see those numbers down, 7.75 million for sawgrass and about 558,000 for real estate. Now the next column, sort of under that comments section, I wanted to provide some additional scenarios. The first one is ignore it. I had forgotten to include that 65% max. So all I was doing in that particular iteration was bringing the domestic equity below 55, which doesn't solve the issue of our 65% maximum. The second column in that's titled 65% equity. So what I wanted to demonstrate for you is how much would be required to take from the equity portfolios just to get us minimally under that 65% threshold. So really what that gets us to is about 64.9%. Just that the minimum amount to get us below the 65% threshold. And then my suggestion, given our largest overweights, would be to the Vanguard Total Stock Fund and Wells Capital Large Cap Growth Portfolio, and then the Euro Pacific Fund. So those three amounts total of $4.85 million. And then again, I've also kind of suggested rebalanced locations. You will notice down in R&D cash that there's a $500,000 number. I reached out to Eddie. He's just about to need $500,000 for benefit payments from the fund. So I went ahead and incorporated that information into this analysis. The last column on the right is a 62.5%, total equity exposure. So from where we are right now at 68.8, if we didn't want to go all the way back to target, which is 60, we just wanted to go halfway between our maximum and our target, that is a suggested, kind of allocation or source of those funds. So again, what I wanted to do is provide, the numbers behind that in terms of those percentages. In a rising interest rate environment that we're seeing, and there's certainly a lot of expectations that rates certainly could rise from here. I think I would lean toward or suggest not going all the way to target and putting 35% back into to the fixed income portfolio. So I think I would suggest probably that 62.5. It gets us sort of halfway on, underneath the 65 cap, but not all the way to 60. But again, I wanted to provide the numbers for all of you to have a discussion and see what you think.
Do you have a projection now what you think real estate would do?
So real estate over the next 12 to 18 months, the projections that we're seeing are somewhere in the 4 to 5%. Below kind of the long-term normal of kind of 7 to 8 or 7 to 9, but ahead of fixed income. There's a fairly realistic chance that fixed income could be negative for a year or two. I mean, it obviously depends on how fast rates rise, if they do at all. If they're stable, then we'll know we'll probably be in the 2% range annually. If rates just stayed where they were today, we'd probably be 2.5% on fixed income return. So still outperforming that. So that is the other kind of component. I didn't line item that here to add the 500,000 back to real estate. And because of the mechanics of how that works, we wouldn't really be allocating that money today. What we have to do is sign a new commitment for an additional, say, $500,000. And then at some point over the next 3 to 6 months, they would call for the money. So from a rebalance perspective, if we wanted to include a $500,000 number, let's just say to real estate, what I would suggest is moving that money to fixed income now. And then when that capital call comes, when we relook at the assets at that moment, on paper, it would come from fixed income. But again, if equities have run up again, and that's the overweight, then it might come from there, but we evaluate it kind of based on that. But that's why we can't just cut a check for $500,000 and send it to JP Morgan. They can't take it. We have to wait for them to call it should they, or if we decide to re-up and rebalance back.
So we're moving money from an asset class that is positive to negative. Now, Mr. Kaler brought up years ago about how we kind of required, if you will, some asset classes to outperform to knowing that there was something that went underperform. And you sat there and told us that George would never go for that, Mr. Forbes. We now have brand new city leadership and new elected officials. It's now the time to look at our allocation and the target ranges.
I would definitely support, expanding the how the plans could be invested. Absolutely.
What would be the negative of it if you obviously increase and decrease range? I mean, if you increase the range, you're not changing. You have to set a target allocation. It becomes something like this. We're kind of screwed when we're kind of stuck with something that's, like you said, generating money, something that's not. If it continues to increase, we're basically knowing we're writing a debt satisfier, the money will give away. We're not going to recoup it.
Over long enough periods of time, yeah, and I think you're referring to kind of negative returns in fixed income. Over the next 5 years, 10 years, as those bonds mature, you won't lose money on them. If bonds go underwater because interest rates rise, as long as you hold the bond, it's going to pay off and you will make a positive rate of return.
Right
Now,
now,
you might have,
in the positive return going 2.5%. Right now, we could be making 8.5 to 14%.
that is absolutely a challenge. But unfortunately, the ordinance says you've got a max of 65. So we could go to some other kind of alternatives such as real estate infrastructure. But, you know, kind of in the current environment, those aren't earning the normal 7 to 8, 9% range. So it's better, certainly better than what we expect out of fixed income. But that's kind of the only alternative that we're left with.
But even if rates continue to rise, real estate's not going to continue to gain as much as it would if rates go lower, correct?
You kind of have to get into why are they going up? How fast do they go up? But yes, that certainly can impact. And if rates if they get significantly higher, then it's really hard to justify increased real estate prices because the cost of borrowing and the cost of servicing that mortgage becomes more challenging. Absolutely. So, and I will say, I mean, we work with a lot of different plans. Having a hard cap like a 65% number in the ordinance is somewhat unusual. That's not all that common. Most plans kind of mirror the state, which is essentially the proven investor standard, which then effectively gives the boards through their own investment policy the ability to set your ranges. You know, if as a board, if you feel comfortable with 70% equity or 75, and including some other alternatives, you're able to do that. But again, you set those limits via the policy, but we have this kind of hard stop with your ordinance that doesn't allow us to exceed that.
That raises some risk, doesn't it?
I'm sorry?
That raises some risk, doesn't it?
It does raise risk is an interesting word because there's a lot of different kinds of risk. So it will definitely raise the volatility. If you have additional alternative exposures and additional equity exposures, you'll increase the volatility of the fund to the extent that it goes up and down, which will translate into funding volatility. So in good years, you have more strong performance and therefore funding drops further. You have in 2008 and 2009, you have more of a down move because you've got this additional exposure, and now funding goes up higher than it would. The flip side is there's a lot of interest rate risk, particularly where you're at historic lows in interest rates. By staying kind of where we are, we're taking a lot more interest rate risk than most everyone else. So you're kind of trading risks, and obviously they have different levels of impact, but those are the things to consider. Yes.
Is there an option to reward another type of investment? Because it seems that the objective is not necessarily to increase the equity investments, but actually to decrease the fixed income investment. And so is there another asset class, like an increase in real estate or another asset class that could be considered?
Absolutely. There are a number of things that we can bring to you. And I'll be honest with you, what we've seen a couple of boards do, kind of this round, so to speak, instead of rebalancing into fixed income or at least completely, they've actually rebalanced some into cash. And kind of from the investment policy standpoint, that's been held as fixed income, but it's not fixed income that's subject to rising interest rates. It's going to earn 20 basis points or something, but it's going to be positive at least, as opposed to potentially, if interest rates move higher from here, negative 2, 3, 4%, or whatever you might face. That's one potential solution that would also buy you time. So if next quarter we have a deeper discussion about some other potential alternatives to move into, that would provide you a little bit of that flexibility. Again, without subjecting us to all of that interest rate risk.
But either way,
is there a time limit on how soon the portfolio has to be balanced?
I'll defer to Pedro on that one.
I think it would be prudent to get us
So-
back to the top of the range in this, but maybe by all means.
I apologize. I couldn't hear the question.
The question was, is there a time frame that we have to get back into compliance with the ordinance? Does it have to be done this meeting, or could that decision be deferred until a future meeting?
So I think that since we're discussing it at this meeting, the cap has always been, obviously something that is enforceable, but it's not something that's enforceable on a day-to-day basis. This board only meets quarterly anyway, or maybe, more frequently depending on special action. But I think that in keeping with the Florida statutes as well, the requirement to be in line or abide by your investment policy statement, for example, it's not meant to be a daily compliance report, right? It's something that is, and your investment policy statement has similar language that allows for some time in order to make these decisions and reallocate the portfolio accordingly. I mean, the basis of these requirements is certainly not so that boards of trustees such as yourselves just act quickly in order to get compliance, but ultimately to the detriment of the portfolio and the assets, right? So this is supposed to be measured. It's supposed to be a reasonable action. We're discussing it now. Obviously, we're aware that we're out of compliance really through no fault of our own, just because the market performance. And so our consultant is bringing some recommendations for us to bring that back into compliance. So I wouldn't have a problem tabling this until our next meeting to take an action. And so the board, if the board is comfortable with that, then we can certainly do that. Or if the board wants to set maybe a special meeting at some point sooner, just to look at this, that would be fine as well.
So, Dan did suggest redoing the current mix, and presumably it's increasing the equities component. And if we did that, we said randomly that we thought that to make the risk hazard. Is that something we table this for now, take it to council and see whether, is that how that, presumably that's how it would be done, we take it to council would decide whether to change the allocation.
In the past, I think I've only been involved with two, at least one when we added real estate, but there was a vote by this body to refer it to the council with the specific allocation recommendation. So I would say it needs to be a little more discussion put into it before we formally send it to council.
So they take a meeting for agreement to do some analysis and come up with some suggestions for us to put that to the council as a request.
Yeah, I'd like to hear a little more about what that's up for your recommendation. You said you would support that. What other cities, what other cities, what sort of is the range?
Yeah, I mean, I actually just did a similar analysis for another plan down in South Florida just a few months ago. I looked at about 20 of their peers within about a 15-mile radius or so, and virtually all of them mirror the state rules, which give the authority, investment authority to the board under the kind of the prudent investor standard. So they don't really impose any limitations. There are no specific limitations other than if it's a police or fire plan having a 25% international registration. So that is the most common kind of language, that's out there. But again, are there exceptions to that? Are there examples of ones that are specifically limited? Yes. But the vast majority just have broad investment discretion. Prudent investor standard, correct.
Which, presumably that means still investment based
There's another
there's some
example.
sort of, understanding what that means.
Well, it's a process where, we come to you with asset allocations. So you see risk and return projections and looking at different asset classes, like, the ones that you don't have exposure to. But we'd also look at scenarios that maybe had 70 or 75 or 80% equity. And then the board says, no, this 80% equity number, there's too much risk. I'm not comfortable there. So we are going to set our maximum in policy at 70 or 75. But it's the board has discretion to make that decision. But obviously in this case, we have the hard stop with the ordinance that doesn't allow us to go beyond. So today you could set it at 50%. You could set anywhere below 65. And that would be set by policy. But and that's, from my standpoint, that would be my preference. For for the boards to have the broadest discretion that you can. You could always decide, you're not interested in hedge funds, you're not interested in infrastructure, or any of these other asset classes that you might talk about or consider. But at least you have the option to say yes or no, as opposed to, you know, a ordinance that restricts what you can and can't.
So where are we on this?
I digress. The last suggestion that you made where Cohill just asked if that would still be compliant with the ordinance. What was that investment you were talking about? I guess it was caps. Your last recommendation that you're talking about.
Infrastructure?
Infrastructure or?
No cash. He said instead of
Oh,
moving it
cash.
to, instead of moving it to fixed, take it to cash, which we're in money market, which is making 20 basis points. So it's not zero, but we've got it. I mean, I think we can say for the foreseeable future that, you know, both the Sawgrass and the PIMCO likely to lose money with everything you put in front of us. I don't think we as a board would be making a sound financial decision. You know, something that we don't have like.
Yeah,
You could say we need a half $1 million.
Correct.
So we probably should, we do need to come up with half $1 million, so probably try to do it.
That's already figuring that.
yeah, it's staggered, but I think what he's saying is if the board didn't want to take any rebalancing action really at all, kind of defer to the next meeting when you have more to look at and more information, but at a minimum, we should do the 500,000 just to at least cover the benefit payments.
My personal thought for this is, we're making money right now on equity, we have the time to push it 2 to 3 months. Why would we take out money now for cash? Like you said, 20 basis points, we can wait 2 to 3 months, make the money we can for this quarter. The allocation on next, either a special meeting or next meeting we have. Motions or how do we do that?
Are there any questions or discussion at this point? I did want to go way back and just ask really quick before we start to take action. Why did you do the 62.5?
Because it's the halfway point between your max at 65 and the target.
Okay.
There's, in this environment, in a low interest rate environment, there are a lot of people, and the discussion has been, well, yes, we know we're overweight and we want to, or we're willing to rebalance, but we don't want to go all the way back to target. We're putting too much money in fixed income or some of these other lower returning or lower expectation, asset classes. So I wanted to give you a scenario and put dollars to it that was just kind of like a halfway point if we were going to get under 65 but didn't want to go all the way to 60.
Gotcha. Okay.
Do we believe that this will have to be by the end of the fiscal year?
Again, it's sort of a legal question, like how long can you be out of compliance before it's an issue?
Right. If that's a question.
If equity markets continue to behave the way they have over the last 3 months, and you make another 3, 4, 5, 6% on your equities, I don't think anybody's going to care. But the issue, the potential concern is, okay, we're over 65, and the decision is for now to leave it there. And then equities drop 10% next week. And somebody comes by and says, well, wait a minute, you were above 65, you let it stay there, and look, we took losses because of it. That's sort of the potential downside. I think Pedro will give you the legal opinion. I think you're okay because we have a plan, a course of action that you're intending to take. Look at alternatives and decide at the next meeting. So I don't really think you're in, a bad spot. But that's kind of the risk associated with that, staying over the target. Is just kind of opens you up to if something adverse happens.
So the taking of the 500,000 out for Eddie's money. We do that anyway. We don't need a vote of the boards.
Correct.
That's something that you guys do automatically. So we don't have to worry about the 500,000. So if we would want to take more out and put it to cash at this point, then we would need to take action on that. And if we want to ask the city council to eliminate the ordinance that dictates the asset allocation, we would need to take action to do that as well. And what you're suggesting is that we ask them just to give us, we would still have our own target asset allocation, but it would be our own and we could change it. So that kind of puts all the eggs in our basket. We don't get to blame or give credit to the council on this asset allocation. So I don't feel like we could do that at this point.
I don't think so. We're gonna go ahead and put that on the agenda.
So I would say my question to you guys is, do we want to move some of our equities to cash? Or just leave it alone at this point and go to the next quarterly meeting where we'll have a little more formal action?
Was there anything over that happened to a benefits?
If we're moving it to reallocate it, that's beyond the $500,000.
I guess if your decision is to not do anything other than just a minimum 500, I think you need to take action. It would only be just if you were gonna do something above that.
Do you feel the cash is safe?
I'm sorry?
You feel the cash, remove cash is a safe one?
Well, certainly, you're not going to lose money. The fixed income over the last 5 weeks is positive. So is it conceivable that, by the end of the quarter, that fixed income has a positive return of 50 basis points or 100 basis points? Yes. So would moving into cash, could that be a lower return than fixed income? Absolutely. But then again, fixed rates, they jumped, they've come back just a little bit over the past 5 weeks. Could this just be a breather before we go to the next leg up and we look at another negative 3%? Absolutely. Trying to predict those times, we can't do that.
Let me ask you, didn't you bring up the whole point of the cash with respect to the reallocation? Because some boards that have to reallocate at that specific time, instead of putting it into a fixed income class, they put it into a cash class.
They decided that they wanted to reduce equity exposure. They were above their limits, didn't want to adjust their limits, thought that, they've earned 40-some-odd% in the last 12 months. They wanted to take a few chips off the table. And traditionally, when you do that, you put it into fixed income. It's not cash, but you're going to earn 4, 5, 6%. Well, we're in a historically low interest rate environment with the prospect of rising interest rates. So they said, okay, right now, we're not going to put it in that traditional safe haven fixed income. We're just going to leave it as cash. As a temporary measure. Maybe that lasts for 3 months or a year, I don't know. But that's sort of the thought process. We want to take chips off the table, but we don't want to put it in fixed income, so we're just going to allocate cash.
What do you suggest you do? Your opinion.
Generally speaking, I'm in favor of following the policy to at least a certain degree. If you're overweight, it calls for you to sell an overweight asset after it's taken a run. If you look at your equity portfolio, it's up 60+% over the last 12 months. So if we took some of those profits and got back under the cap, I don't think that is a bad idea. Again, for the equity market, go on another run tomorrow, absolutely. And then rebalancing is not the best outcome. But we don't know that. We don't know when that's going to happen. So our general position is when you find yourself overweight, trim it. You don't have to trim it all the way back to target, but that's why I kind of put it in both the 65 and the 62.5. It's trimming, but it's kind of doing those minimum amounts relative to the policy.
But with the state, just look at that, say whether you're 65 or 62.9 or 61, you're still over.
Because the action taken at the board meeting was to get it under the cap. So then any subsequent move, if we went right back to 68 next quarter, well, at your next meeting, the next time you found yourself over, you'd be in a position to take corrective action.
The subtext here is that, again, the market's been doing well, but in the absence of a new bill, Apple's every reason for this, but I'm cashing in all the chips. 65 to 60, I think I like the 62.5 option. It does demonstrate that we're conscious of the rules that we have. still, you know, maybe keeping some chips on the table, to stick with that medical.
Does that take us overweight with the cash, that 10%?
So, I mean, as of today, you're at 68.8% equity. So if we took 6% out of equity, you know, again, you have a 10% limitation on cash.
So the 4.85 would take us right to 65.
The 4.85 million would take us just below, it's like 64.9% as of today, you know, but again, or as of yesterday, so it changed by the end of the day.
Everyone's more optimistic, as the market. What kind of risk do you see ahead going forward? Everyone's looking forward to opening, but when I see valuations that are kind of going out of control, stock prices that are too high, way higher than it was before the pandemic even began. So what's your take on all that?
I'm gonna sound a little bit like a fence sitter on this one. There's pretty much everything you look at is positive.
Mhm.
Vaccinations, stimulus, economic indicators, all of it is pointing up in the direction like we're gonna keep going. So if you just looked at today's information, you'd say, sell all your fixed income, don't have any cash, 100% equity, go. It's gonna be great. But the caveat to that is the market is always looking ahead. So we started to talk about inflation, we moved a little bit, but if over the next 3, 6, 9 months, inflation really starts to percolate, that's going to create a problem. And again, the moment the market really sees more of that movement, they're going to then become concerned it's going to be a bigger issue and take immediate action. They're not going to wait 12 months for inflation to go from 2 to 5. You know, I'm just throwing numbers out there.
Right.
They're going to react once they start to see that incremental growth. So that's one concern.
Think they see.
Oh, they think they see it, right. So that's
Sort of herd mentality.
We're at that point where
Yeah, and turn around.
the other item that is the constant geopolitical risk. I mean, there's nothing immediately on the table, but issues with Russia, with China, with North Korea, anything could happen. So when you're at an elevated environment where stock prices are a little bit higher, and you have some sort of geopolitical event, immediately, the most typical reaction is what's called risk off. Sell your equities, buy your fixed income. And so that, again, is another one of the risks. I'm not going to sit here and try to predict a geopolitical problem or event. And we're not, you know, we have a general expectation for higher interest rates, but we don't think they're just going to spike dramatically and get back to 1981. I think, you know, over the course of a couple of years, they'll go reasonably higher, but we're not expecting this huge ramp up and crazy runaway inflation. So kind of with that said, it's tempered, but you asked the question, what are the risks? What are the biggest risks? I think those are the biggest risks. We don't really try to make calls about any of that stuff.
Right.
What we boil it back to is follow the policy.
Mhm.
You know, when equities run, or fixed income does well. I mean, if you think back to the COVID market last year, we were taking money out of your fixed income because it held up, it was positive, and all your equities were down. 12 months later, things have flipped. Our equities are up. Could they double from here? Absolutely. We have no idea. But generally, we say that we've got the policy in place. You know, there's room around the edges. You don't have to go exactly to target, but certainly when you're outside, I would lean towards getting back into policy. With that said, I don't think 68% equity in this environment, in this low interest rate situation in a positive economy, is a bad place to be. I have some clients that are 85% equity, or one in particular, and many that are over 70. I don't think you're an outlier, but again, it's just relative to your policy and your rules. You've had those gains, you're above that target, so again, that would be my tendency.
I'd like to just move cash to that 64.99%, and then for a period of 1 quarter, we can certainly take a look at what's happening in that 1 quarter. See the direction that we're going.
Can I make a motion for police board?
Sure.
Let's move 4.85 million from following breakdown, 1.35 million from Vanguard, 2.9 million from Wells Capital, 600,000 from Euro Pacific, we have a cash account. That is from Brendan, 65% column.
Okay, there's a motion from Bill for the police board. Is there a second? on the
Second.
police board? I want to, if you guys are okay with it, let's do discussion as a group, and then we'll continue with the votes by the board. This goes along with what you had just suggested. Any other comments on just moving the overweight completely in cash?
I'm okay with that. I think that I would like to stay within the policy. However, I really want to look at the ordinance change. I think that, like you said, it's very restrictive, and I would like to see these target weights move from the ordinance to a policy level. And obviously, we know it's going to take council. It's going to take several readings. We get that. That's going to take time. But at least now we can rebalance it over inside of the ordinance, and then hopefully at the next meeting we can look at some of the target weights for the asset classes, and then we can start the process of going to council to move this back to a policy.
Is there any other discussion?
Yeah.
Where's the 4.8 as a cash percentage? That puts over 10?
No, it'd be roughly 4.6%.
What's the, did you base your decision for Vanguard Wells based on last year's earnings, or did I miss that part?
It's indirectly that. If you look at the add reduce column, you'll notice they have the largest negative numbers. It means they're the largest overweight. The reason they're the largest overweight is because they've been growing the most over the last 12 and 18 months. So it's kind of indirectly a performance thing, but it's just the fact that they are a larger piece of the pie. So by taking those amounts from them, they still don't even get down to where the JP Morgan value allocation is at $1 billion.
Any other discussion?
Mayor, may I hear the motion again, please?
Motion was to sell 4.85 million from the equity portfolio following breakdown. 1.35 million from Vanguard, 2.9 million from Wells Capital, and 600,000 from the Euro Pacific. Move proceeds from that into cash.
Thank you, sir.
Okay, we have a motion from Hoagland, second by Sharp on the police board. Any other discussion? Roll call.
David Cohill,
Yes.
Marvin Dupree,
Yes.
Jason Sharp.
Would the firefighter like to make the same motion?
Same motion.
Motion by Kindler, is there a second? Second by White. Any discussion, firefighter board? Roll call.
Gaylord Cameron,
Yes.
John McDaniel,
Yes.
Debbie White.
Yeah.
And the general employees, would anyone like to make the motion?
I'll make the motion.
Motion by Jansen, is there a second?
Second.
Second by Curry, any discussion? Roll call.
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie McGar.
Yes.
Okay, motion passes all three boards. Follow-up question, would we at some point in here go ahead and look at moving some of that into real estate? Or do we want to wait until the next quarter to do it?
I
think it's a small enough consideration that I would just defer that into the broader discussion with other asset classes.
Okay,
On the next meeting, what do I need for agenda items? Do I need to go ahead and put something on there for the possibility to refer to council, the option or the request to, or are we going to wait to hear from Brendan on what a more research and more suggestions before I put that on the agenda?
I would like to see some more research on it before arbitrarily, but I asked earlier, and it was kind of if you're having a solid answer, but I don't think either what risks are involved. When I say risk, to the city, by relieving the cap and making it whatever you want to make it, 75% limit. How does that affect the city's coffers?
Okay, kind of the question, kind of the same thing as far as risk goes. I don't mind obviously getting rid of the ordinance of how it is and how we're really going with that. But what if we just do a cap rather than a range? Rather than saying, hey, you should be happy within this 10% of everything. It kind of limits us what we can do throughout. If you do a cap of, say, 75% or 70% on majority of things, how would that work out?
I guess it's a question of paper, right? And obviously, if we push back to the policy level, it's something that we could look at for an investment strategy on a meeting-level basis, correct?
Before it goes over to council.
Well, our hope is that it comes back from ordinance, which is the way it is now, back to policy level, which this board would then set the investments.
Yeah, I think it is more research. I might be.
Jason, to answer your question, I think what it does, if you just set caps, what you will, in your monitoring, in the report, we're setting everything against the ranges and against the targets and against caps. So when you look at the report, it naturally is going to show you deviations. Hey, you're now 5% overweight, you're 10% overweight or underweight. And it is almost a call to action, or at least to recognize the issue. If you just set maximums, and let's say in your mind you think small cap should be 10%, and it has an awesome year and it goes up 300%, and now it's 25% of the fund. Well, if the cap is just 80, you won't see that as an item. So it's just a way to kind of focus on its relative, weighting and allocation against the entire fund as a way to monitor. But I do agree that having that arbitrary cap or putting that maximum is.
My worry would be kind of like where we're at now is you have your range for bonds or fixed income. We have to get within that range and it's already so much lower and it's already going down. Now we're stuck putting money into something we don't want to get it above the cap or the bottom.
I think that the difference is when you don't have the hard ordinance limitation, you set your investment policy range. And let's just use fixed income as an example. This is a conversation that's being had in a lot of places. Okay, our range is 30 to 40%. We're at 28% currently, or wherever. What do we think? Oh, well, it's a low interest rate environment. We've got to look at other alternatives and not do fixed income. So we're going to change our range to 20 to 30 because they don't necessarily have the limitation in their ordinance. So they can have the fixed income be 5%. So they're changing their targets. But again, by having the target in the ranges, it causes the conversation to happen. Because all of a sudden we see we're overweight or underweight. So then in the meeting we talk about, hey, we're way underweight fixed income because performance has been subpar and our equities have been phenomenal. Given where we are today, are we comfortable with this or do we want to make some adjustments? And they may or may not make an adjustment. But I think that's the primary kind of benefit of it. But again, the idea is the board then has the latitude to just adjust the ranges if they feel that that's appropriate.
Or are we at this point out of compliance with the fixed income? So we're making a big push to bring them.
You're out of compliance from the investment policy range that's set, but that one is not a hard stop. So, and I would sit here and have the discussion or the argument that cash is fixed income. So in the policy, we do kind of break it out as a different, it's really more to limit cash than it is to justify fixed income. But I think most people would agree that if you have fixed income and cash that total somewhere in that range, you are in compliance.
I'm surprised too, what you said a long time ago, that most boards don't have this in their city ordinance, because I almost feel like that's a backstop of, and not that our board would do this, but I'm sure there are boards that would kind of chase waterfalls and jump more into equities than they probably should because equities are performing well, or vice versa. So that's my only hesitation, is that this gives us a backstop that we can't just follow things on a whim. So and I'm coming from the council side, obviously, but it seems like that provides a little bit of the backstop to us just chasing things.
I mean,
It's around chasing. Right now, the ordinance that council has imposed upon this board says that we don't have to move money from something in an asset class that is doing a positive return into an asset class as a negative return. The reason it fits.
Right
is
now
so-
it is, but that's not always going to be the case. I'm just saying that ordinance went into place for a reason at some point at a board, pension boards before us, and there will be pension boards after us. So I'm just saying that ordinance was probably to provide some sort of continuity and framework for this board. So I just want to consider that before we.
Again, we're underweight in fixed income because it's losing money. So we have to slide money. The ordinance says I have to slide money, this board, from an asset class that's making money to an asset class that's losing money. I think that just as slow as the process is to change the ordinance, I think that these three boards are better served to have the asset allocation policy rather than the ordinance.
And don't get me wrong, I'm not excited about this. I don't want to lose money either, but I'm just saying it's not always going to be that direction. It can be the other direction. It can be different boards. And so just if we can vote on the policies that govern our investment decisions, it's more responsibility on our part for sure. So and that's why I'm just saying I'm surprised that that's, as you say, the way a lot of pension boards are operating right now.
The only thing I think I would offer is that although a great majority of boards or a lot of boards have that authority, they're not taking it to the extremes. If they have, plenty of them, I'd say the average is probably a 25%, 20 to 25% exposure to fixed income. They might have somewhere between 10 to 15% alternatives, and maybe as high as 65 to 70% equity. They theoretically could go to 90% equity. Could have done that a couple of years ago, but they're not. They haven't. I mean, there are, I have one. They could, but they haven't. And every time, at least that I'm involved in that conversation, here's an asset allocation. Here's what would happen, or given the projection for returns. If you went to 75% equity, 85, whatever those numbers are, here's the potential increase in return, but then here's the increase in volatility, the increase in risk. And beyond a certain point of equity, and you lose that diversification, you get a larger increase in risk than you do an increase in return. And that's often the point where boards will say, no, we're kind of comfortable here, because yes, we can pick up an extra 2 basis points of return, but we're going to get an extra 10 basis points of risk. That's not worth it. And so they'll tend to stay there. But again, with that change to the ordinance, the board has the ability to adjust. But that's where I would say that's where the vast majority end up. But again, that is from a city's perspective, that is a risk. The boards could all of a sudden decide, let's do 95%.
But at the same time, the council could also vote to do 95%.
Yeah, but then we would have to decide to implement that. I mean, it gives two bodies influence over those ranges. So I'm not arguing one way or the other. I'm just
It gives
throwing that out.
one body influence, and the second body has to operate within that influence.
The flip side is too, just using this extreme example, if the council will opt for Auditor through the standard, and then the board went from 99% equity, just change the ordinance. Again, I don't.
It's not that easy, you guys.
But I mean, not that I would ever think that would actually happen, but it just, in that extreme example, you still have the ability to influence that if they were completely uncomfortable with that direction.
I would still like.
This is Pedro. Oh.
Go ahead, Pedro.
Oh, I'm sorry. I think I cut somebody off, and I apologize. I was just going to suggest. I mean, an alternative is also, and I've seen it in other places as well, and I think it kind of splits the baby, if you will. Is just increasing this, rather than just eliminating the cap altogether, you can just increase the 65% at market to insert number, right? That would be somewhat appropriate, but still allowing for that backstop, right? So you can maybe say 70% at market or 72% at market. something like that where I would imagine, our consultant is likely not going to be advising us or recommending that we're going to be going anywhere above that anyway. But it would provide for, that added flexibility that we're looking for. And so, again, it's just another thought that maybe council will be more receptive to, rather than just eliminating it altogether, just putting in something that gives us flexibility, but still provides that sense of comfort that the council might be looking for in terms of, what's permissible and what's not.
Pedro, do you have any idea as to why historically that was put in place, the 65%?
I don't. I mean, I can say that, this is that 65%, I've seen it in other places. So, I think it may just have been a product of the timing of when these ordinances were being implemented. And that was kind of the rule of thumb was maybe, these assets were being split 60-40, maybe 70-30, something like that. And so they just picked the 65. I don't think there's any basis for it in the statutes or anything like that. I think it was really just more a product of the timing and the circumstances when a lot of these ordinances were all kind of being passed. That's my best guess. It's not a very good legal opinion, but that's I can't say. I have seen it in other places. The 65 number seems to have been a popular one, and so I can only estimate or assume that I think it was just based on the timing and the circumstances and kind of the asset allocation, the prevalent asset allocation being around that 60-40 split, maybe 70-30 split. They ended up with that 65 at market to kind of be in between.
I think we were at 60-40 once and they did change to 62.
George, were you saying something? I'm sorry.
Actually, Pedro, beat you to it. I think your backstop, the equity limit was raised a little bit. That one, you saw a big part of the country. And here, I think the thing too, that, it comes between us and council. Council, we're left to keep working. So, other than, okay, well, that's a different story. But anyways, I think that's another alternative.
So we need to gather some more information. We'll revisit it at the next quarterly meeting and potentially take action at that point if we feel like we've got something we'd like to propose, a change to propose to the council, whether it be a change in asset allocation or a change in the structure of how we manage that. So capture that accurately. Okay, let's move on and finish up this weighty and full agenda. So we've got the last item for Brendan on the Wealth Capital Management.
Yes, so Wells Capital, all of Wells Fargo is selling all of their investment management boutiques, kind of a full sale to actually kind of a blend of two companies. So you have a consent to the assignment, essentially allowing the new entity to take over your existing contract that you have with Wells. We're not anticipating any changes to the investment team, to the strategy. It's really just an entire lift out of all of Wells Fargo management, and this is happening in a lot of places into this new entity. So given the fact that we don't anticipate any disruptions to the team or the portfolio, we would suggest agreeing to the consent, again, assuming it meets with the legal requirements from legal.
You know who it is?
It is GTCR LLC and Reverence Capital Partners.
So trustees, as you just heard exactly right, it's essentially a consent to assign the contract. So from a legal perspective, we're comfortable with the assignment, essentially of the same protections that you had in place with your investment management agreement with Wells Capital Management would remain in effect with the new entity, right? That the contract is being assigned to. So from a legal standpoint, you're in the exact same position that you were prior to this assignment. So nothing really changes in terms of your liabilities and or protections. However, obviously we always recommend that we get from the business side of it, right, from the financial side of it, whether or not ANCO feels comfortable with the new manager, in terms of people, process, et cetera. And so from a legal, it's kind of two decisions, right? From a legal standpoint, we're okay with it. There's no issues. Everything is as it was. It's just a different name on the contract. And then from a business side, whether or not we want to keep these folks, because obviously these aren't the people that we hired originally, but whether or not ANCO still feels comfortable with these as the new managers in terms of just people, process, et cetera. And I think you heard that they do feel comfortable on that front.
Just so there is no change in the actual people investing the money or anything else. They're pretty much just changing the name on the building, so to speak. But with any transaction like this, even when it's stated that nothing's going to change, no personnel are going to leave, anything like that, we're still going to watch it twice as closely as we did before, because sometimes in situations like this, a year later, 6 months later, people start leaving, things start changing. So we would certainly watch it extra carefully because of that. But at this point, we're not anticipating any changes.
Okay, so we need a motion from the boards to approve consent to the deemed assignment of the investment management agreement due to the purchase of Wealth Capital Management Incorporated by TTCR LLC and Reverence Capital Partners LP. Let's start with general employees. Can we get a motion?
Motion to consent.
Motion by Curry, is there a second?
Second.
Second by Vergara. Any discussion? Roll call?
Nick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman.
Yes.
Eddie Vergara.
Yes.
Motion carries. Firefighters, is there a motion? Motion by White, second.
Second.
Second by McDaniel. Any discussion? Roll call?
Gaylord Cameron,
Yes.
John McDaniel,
Yes.
Debbie White.
Yes.
Motion carries. Police, is there a motion?
Motion.
Motion by Sharp, second.
Second.
By Copel, any discussion? Roll call?
David Cohill,
Yes.
Marvin Dupree,
Yes.
Jason Sharp.
Yes.
Motion carries. Thank you, Brendan. That was
Sorry it was so long, but
No,
a lot of good things to get through and ultimately good news.
a lot to talk about, exactly. We're in a good situation when this is our. Dustin, pension administrator report. Oh, Brad,
Oh, I interrupted. My apologies. I don't know, this may be in the administrator's report, but I wanted to update the police officers board on the status of the service purchases. The first half dozen will probably be delivered later this week. There was a little bit of a delay because of there was someone in the internal audit that was approving the final average salary calculations for purposes of service purchases was on a leave. But we think things will start moving a little bit quicker to get those delivered for review and decision-making by the police officers with respect to those service purchases. And it's my understanding, and hopefully Pedro went dark because he's still here and listening, and not because he left his desk for the moment. But the date of application, I believe, is what's going to drive the decision. So as far as Dustin and Pedro and the police officers board of trustees are concerned, I believe it's the date of application that's going to determine the calculation of the final average salary and thereafter the service purchases, so that we don't have differences attributable to administrative procedures. So that's our position.
That's my understanding as well, Brett. State of application.
Great, thanks.
And I
Sorry.
agree. And I'm still here, Brad.
It's the closest I've been to Pedro, like face to face. We're less than 6 feet away, I suspect.
I'm just
From our
trying
screens.
to figure out how to get the locks you got onto my side of the on the screen, but
Well,
Okay, back to Dustin for the pension administrator's report
The budget, actually.
and the budget. Yay.
Yeah. So in the interest of ending this marathon, I'll try to be pretty quick with this. As you know, pension budgets are usually too complicated. Most of our expenses are fixed. We've already signed contracts with Info and our service providers, other actuarial attorneys as well. So I'll just kind of dive right into it. I've got a memo and some detailed information there, but I'll come into the presentation here. Excuse me. Investment earnings, we have a conservative investment assumption, earnings assumption of 7%, just to be conservative. No member contributions, 7.95% every year, and then the city contribution this year, 2% decrease for general, and I know 44% decrease for police kind of jumps out at you at why. That would be, Brad kind of touched on it earlier with there was some excess contributions that had been set out there for a few years where the plan, the city would assume how much we were going to get in those tax revenues, and then what actually came in, if it was more than that, would just be excess contributions that would continue to be held out there. It's never really been utilized, and it's been building up over a few years. So the city has made a decision to utilize that in the upcoming fiscal year, so that reduces the city's contribution that's required for that fiscal year, about $200,000 below. So that's why the contribution for police is for both posts. Tax revenues based on October 1st, 2020 actual evaluation, and the police revenues were just projecting out as same last year. That's best guess we have is what those are going to come in at. For expense assumptions, consistent with prior years, fairly consistent. We do have some increased pension benefits. We'll get to down there. Personnel services is just an allocation of my salary for the three pension boards and the city paid portion as well. Pension benefits is current year benefits paid plus the retirees projected to begin receiving benefits and backdrop payouts in 2022. It's kind of hard to project those backdrop payouts in the next, for next fiscal year. People literally contact me, a month before they say, hey, I want to retire. So it's kind of difficult to project those out, but we use some historical data and go from there. Other current charges, we removed the proposal to upgrade pension software, which we put in. Just kind of status update on that is the city's ERP system kind of underwent an analysis, is now kind of rotating back through, and that there is a company that's helping the city with that ERP implementation, and they're starting with utility billing, then going through human resources, payroll, and communication. Once we get through that, then we can readdress some pension software that they interface with the ERP system once it's implemented. So we're just kind of stabling this pension software to be readdressed at a later time. But we left in some contingency monies in there for if there is something throughout the year that the board doesn't take action on, just kind of not slush fund, just to have something available and set aside. For general employees, revenues on a more detailed note, you see there's 7%. Of course, the earnings investment member contributions number comes from the actuarial reports, and So that's kind of hard set on our Brad mentioned these numbers in this report. That's estimated total revenue. We're at about 4% for the year. Now, this is, just a stab in the dark. Who really knows what our investment earnings are going to be toward next year? I can't possibly guess that, but we have to kind of assume something. So that's where it's at. On the general employees expense side, we have 3.7% change for the investment. Really, that's a 3% change, but the city is trying to get me to change just to get to some more round numbers. I think Mike likes to have more round numbers in the budget. So we just kind of move that up instead of straight 3% to 13,500 for budget purposes. And then same kind of thing on the management custodial fees, down 23%. That's just to get to a more round period. In a normal year, when we had performance like we had in the last year, you would think that we would up management custodial fees because we now have more funds that are being charged fees on. But our budget for our management custodial fees has been more than adequate in prior years, so we decided to leave that kind of flat this year and maybe look at that again next year. Other expenses, that's where the reduction of the pension software fee. On police officers' revenues, and feel free to stop me at any time if you have any questions on any of these. Police officers' revenues, we have the same for the budget increase there. For the 251,000 of the actual number for the police tax returns last year. There you see the 444% reduction, which led to that's not right. I'll just fix that before we, it's right in my numbers, but in my presentation here, I didn't have those numbers through, I guess. And the total contributions we have, the total revenues, that should be quite lower. I did that after that, my apologies. Moving over to the expenses side, same kind of number changes here, 3%, increase in personnel services, 3.7 for investment changes. And then the other expenses, we have the reduction for the pension software. In the firefighters budget, we have reduction in member contributions. That's just a product of having a few fewer members over the previous year that we had retired when they left in 2019. That's just kind of rolling through now. And not much change otherwise there. In the firefighters expense side, we have the 3.7% increase again in investment, only a 3% change in personal services. Pension benefits, 50% increase. We were quite under on the pension benefits for the firefighters. As far as our budget was lower than where it should have been, so we were over in the actual. This is mainly due to when the firefighters did. There's a couple retirements there in that year that are these people are now continuing to receive it, and they were, at top level. So now our commission benefits, expenses on a yearly basis are increased. Any issues with any of this? Any questions?
There's no questions for Dustin. Let's go ahead and get approval of the 2022 proposed annual budget. Let's start with a motion by firefighter report.
To approve.
Motion by White, second by McDaniel. Any discussion? Roll call.
Gaylord Handler,
Yes.
John McDaniel,
Yes.
Debbie White.
Yes.
Motion carries, please.
Question for you, this.
Yeah.
That's question for this.
Let's do a motion in a second, then we can do discussion.
I guess, I'm not gonna, it has to do with the numbers being wrong on the police side, so is that gonna matter?
That goes on the presentation on the,
Is there somewhere else they are correct? Are they correct in the black and white? Yes.
Do you want me to come back to you guys?
Yeah, didn't want.
Okay, let's head to general employees. We need a motion to approve budget.
Motion to approve.
Motion by Curry, second by Jameson. Any discussion? Roll call.
Dick Curry,
Yes.
Dan Jansen,
Yes.
Christine Hoffman,
Yes.
Eddie Sakara.
Yes.
Budget passes. Please just let me know when you're ready.
So correct in the black and white. Is that right?
It's like one shows the same number. 402, 828. Yeah, it looks like what he did was back out to 185 excess. There's nowhere do I see that happen. 185. Correct me if I'm wrong, this budget doesn't include any of the 185 contributions, so it's just going to show the city's contributions.
right.
I believe that number of 402 is accurate because there's an excess 185s we discovered during negotiations with the 122 budget.
Right. It's not, we don't have a budget for it because it's not already, it's already.
Well, this budget doesn't include 185. This only includes the city contribution. Right, actually check the right.
Correct.
So technically it should be right. I mean, based on when we finished up negotiations last year, this was kind of what we were expecting. So I think it was a little over 300,000 that was discovered. Do you know, $300,000 on there?
Love it.
I mean,
If that's the right number, then I'm good.
that's actual check, I think the city's right.
It's here, it's on A3 of the, that's the
Brett's.
Brad actuarial
Which page, A3?
A3.
So that less accumulated prepaid contributions are 200,000, that's the number we found.
Right.
That's what's actually. 17. That's what the city should pay. Well, that's what they're getting.
All right, motion.
Motion by Sharps, there's second.
Second.
Any other discussion? Roll call, please, board.
Marvin Dupree,
Yes.
David Cohill,
Yes.
Jason Sharp,
Yes.
Motion carries. All right. Now take us on.
Now,
the reason we had so many people in our list there, was, I think, during COVID, there'd be uncertainty, I think that we like retired for 6 months. And then all of a sudden there, and people like maybe returning to point on that, a few people started retiring again, and we didn't have an actual meeting last quarter, so we had 2 meetings worth of retirement approvals, so that's why you saw 8, which was abnormal for us. So, just gonna jump over the plan membership there, go to that PPTA conference, I got 2, Jason are interested in going to the conference, I think that's what Pedro mentioned. I have a little trouble hearing what he was saying earlier about maybe they're like looking rooms for that or something. And I'm gonna have some trouble with that, so
So the rooms are being booked, but they haven't opened up yet. My understanding is that PPTA is the only thing going. So, and there's a limited number of rooms, so you can just go book with the hotel, the only people would be going for the PPTA. So even though they haven't opened the official portal, like the reserve through that PPTA, I think you can just sort of down. That's my understanding.
yeah. The only problem with that is you don't get the PPTA rate when you do that.
I think because the only people that are staying there are with the organization, it's the same. Again, I haven't looked into it, but that's just sort of what I've been hearing.
That's awful to get off site. It's be awful.
You know,
You do every day.
yeah. It's kind of that convolution over there. So if anyone is interested, please let me know as soon as possible, so that we can get you in now. Pretty much everybody who is CPPT certified should be attending the fall because of our requirements with maintaining that membership, and the annual conference is only worth 5 points versus the fall continuing education for 10, which 10 is going to be.
Where is it going to be in the fall?
I don't know.
It's here.
Was that?
And then
Oh, really?
where is the Sawgrass?
Yeah.
It's all more recent ago. It's here, Sawgrass. As for required disclosures, every year we have to do these Form 1. So I actually included those in the agenda package. Now, you probably don't use this paper form, it's inbound, but I could send out the PDF to, it's in that agenda package in the PDF form. So if you want to fill it out in that, just print those pages, you can do that. I can also just send out the Form 1 individually to everyone in. But there are financial penalties for on you, the individual, if you don't complete those. So we want to make sure we get those in, including myself.
What's the due date?
July 1st. Yeah, July 1st. We also do have, I didn't put it on here, but we've got upcoming elections as well. Upcoming elections for police and fire for the never elected 2 spots. So we've got 4 elections that will be coming up soon, and we've got some. I'll be working with the clerk's office to see how we're going to do that. The fire should be interesting since they're no longer here.
You know, all the same email addresses or anything anymore.
Right.
Well, we should definitely get you the Jacksonville email addresses for everybody.
So that's
Go with that.
Yeah, that's gonna be my next thing, was give you a list of all of Jacksonville email addresses for those people. And I don't know, I gotta work with the clerk's office, see, because these have always been in person, letter signed. So I don't know what our limitations are there on that side. I just don't know that information. So we'll have to see about that. Maybe it has to go out, a certified letter. I'm not sure. We'll be on that sooner rather than later. That's coming up pretty quickly. Next meeting scheduled for August 11th. That
that is right off the town, I'm planning to move back to Jacksonville, so I'm not sure how I'm gonna do that, but
Around the U-Haul.
we'll figure it out.
Bring kids.
Yeah. Figure it out. I think that's all for me, unless there's any questions.
All right, there's no other business. Thank you guys for powering through a long and very involved meeting.